Welcome everyone to the India market review for the week ending Friday 8th September 2017. We're actually doing an IMR after I think almost a break of 3 weeks or maybe even 4 weeks, 1 month. A lot of things been happening around for the last 1 month, bit of traveling, etc. So that's why no sessions. So without further ado, let's jump into today's session. Broadly, we'll of course be looking at the Indian stock market and things like that that we normally do. But also, in addition to that, we'll have a very brief look at the valuations side of the Indian market. And that will set up the stage for a very in-depth and detailed evaluation of the entire market on a fundamental basis, something that we do well, or at least we try and do every quarter, but especially we do it when the market is at certain important highs or lows to take a very different perspective on how things are fundamentally. And so we'll do a very brief review of that. It'll give you a sense of where we are, but also it'll give you a sense of what you can expect in the extremely detailed review that we will do. For those of you who have not been in a deep FA review, well, I would definitely, for those of you who have been, you know what it is all about and how extremely valuable, insightful, and profitable, and obviously actionable those reviews have been in the last couple of years. And for those of you who have not, I would definitely encourage you to seriously participate in the next one. The dates will be announced soon, especially actually I was going to say for long-term investors, but really even for short-term traders, these reviews can be very insightful, especially if you're a positional trader. So long-term investors, positional traders, etc., can massively benefit from it. So we'll touch upon that, like I said, briefly, and then we'll go on to the part 2 of the IMRs as we usually do, and look at specific stocks and any really good setups that one could perhaps look at in the coming week. Right. All right. So with that, looking at what the market is up to, let's have a look, and we will start with we'll start with okay, that's the FA chart, which we'll come to later. I'll start with the Nifty as usual, and here is the Nifty watch list, sector indices, NSE. Right. So this is where the Nifty is. We might hear a lot of thunder in the background. It's been raining quite heavily, intensity going up and down in the last 2 hours at this point. So if you hear anything loud, it's mostly thunder. All right. So moving on. This is the Nifty as as of today, end of day, and what is very clear, fortunately so far, is that the uptrend is definitely very much intact. The higher top, higher bottom pattern is definitely very much there. This support has not been broken and it has not fallen below 9,700. So that's a critical level to watch out for. You may want to put an alert there at some point for 9,700. If 9,700 breaks, then at least we don't have a higher top, higher bottom anymore. And the issue is that right now, the way this is going up, there is definitely some amount of hesitation, etc., which is there. And looking at the indicators, etc., Really nothing spectacular or particular there, which adds to or minuses from the view. So as of now, uptrend looks like 10,000, 130, 150 is the next level to look out. But from I think 1 month perspective, one can definitely say that there's a sort of consolidation which is going on. Overall, short-term and long-term trends are all up. So one could be looking at long and bullish setup. But when we do the sector overview, that could change. Uh, this is the state for India. Looking at the global market, starting from the US, you have the Dow Jones here, and earlier a month back when we were talking about the Dow Jones, this was the um, price action which was there, and it was clearly looking like it was likely to head down. Clearly it hasn't done that. This uptrend was broken for some time, but it has recovered that, and right now the best is that the Dow Jones is going sideways. And with all the hurricane activity on the east coast and the bushfires on the west coast, things are really going from bad to worse in the US from an environmental and perhaps infrastructure perspective. And what the cost of the economy will be is definitely something that we'll have to look to see how that might affect. But for now, it just seems the US Dow Jones at least is sideways. If you look at the Nasdaq, then that's also sideways. It's made a nice consolidation sort of bowl there, and this could potentially be a flag which is happening. And if it does break out, then new life highs on the Nasdaq are something that could happen. And the long-term trend on the Nasdaq is clearly up, and so it is on the Dow Jones. So quite clearly it is on a very bullish side. So this is the Nasdaq, and then moving forward, look at Europe, starting with Germany DAX, and that had been on a downtrend for quite some time, and then it has gone sideways, and now seems to be, after a period of about about 3 weeks of consolidation, maybe on its way back up, but at a very important resistance at 12,400, and we'll have to see what it is able to do after that. And as of now, looks like it'll break the 12,400 and break out, but that's premature. And I think the German elections are around the corner, so it's probably wait and watch. I think it's this month, if I'm not wrong, the German election, and that could move the market one way or the other, or at least the German market is likely to be perhaps sideways till the German election is out of the way, the German general election. Looking at UK, Brexit, a lot of ifs and buts about it, a lot of division within the government and the ruling party about how to go forward. So again, no clarity, but very clearly sideways since May. So that's 1, 2, 3, 4, 5 months of a clear sideways move on the FTSE. And I'm really not sure whether this could also be attributed to the German election now, but it's definitely partly Brexit, and now maybe the German election a little bit, and how that might influence European policy going forward. All right, so that, and then looking at the CAC, France, so more or less similar picture to Germany in the short term, though this still seems to be a sort of downtrend here, which is still in the making. But clearly, if you look at the MACD, RSI, etc., there is a bullish divergence which is happening on the daily chart is not yet happening on the uh, weekly chart or monthly chart, right? So some bullish divergence there on the MACD daily chart. Uh, doesn't mean that it's going to move up, but all right, a slightly bullish sign, but otherwise still a downtrend on the uh, French index. And then finally looking at Nikkei, so that's also just sideways, really doing nothing, and really no update on that. So that's clearly going sideways. And in Japan, I don't know how much the North Korean issue is an issue which is weighing on the Tokyo Stock Exchange with the belligerence and the improving launch and who knows strike capabilities of the uh, North Korean missiles. Whether if something that happens, and that could really happen anytime, we will just see the market just collapse in a blink, right? At least in the short term, that's very likely to happen. So overall, if we look at the global equity indices, they seem to be all sideways. Europe slightly, definitely sideways, but US again also sideways but with maybe a slightly bullish um, bias to that, right? So I don't think there is any compelling evidence one way or the other for either an up move or a down move from the global perspective. But from and therefore coming back to the Indian setup, this up move has really no cues from global charts. So very much on the Indian thing now. We know that GDP figures have come down. The government is attributing that to GST and transition and all. Of course, the opposition has a different view, or that demonetization, etc., has not worked. And then there is, the festive season coming up, Dasara and then Diwali, typically good time for a lot of consumer goods, auto companies, etc. So we'll have to see how that pans out. Uh, so I can't think of any, overall great cues from a current affairs perspective, except sentiments. Fundamentally, there doesn't seem to be too much in terms of news or activity, at least not that I'm aware of. And technically, this is looking, yes, long-term bullish, but I would say that with a lot of caution at this point. Event risk, global event risk is, I think, pretty significant. So that's one thing to keep in mind. And if you look at this, the upper Bollinger Band has moved down, and there's definitely some consolidation going on. There's Bollinger Band tightening which is going on. And for now, it just could be a correction, but well, we'll wait and watch. So really nothing compelling on the Nifty index. So while we are at it, let's look at the, where is that now? So this is the Nifty chart. Now this is actually not updated. So we're looking at the fundamental charts now. This is of course not the fundamental, this is the technical chart of the Nifty. And I should have had 50 everywhere. Oops, sorry, 0. All right. So now, right now in this IMR, this is not really updated data. We will be working on fully updated data when we do the deep FA review. So this is updated till 28th of July, for basically say 1st of August. So this is about 5 weeks old. But overall, as far as FA is concerned, this is really not a concern. And it is essentially when the Nifty was at around 10,000, and now the Nifty, as we know, is at 9,900. So practically speaking, from a fundamental perspective, it really doesn't make any difference. We're talking about decimal points differences on the FA ratios. So for all practical purposes, from a fundamental perspective, the statements and analysis going forward on the Nifty here are all current and up to date. So with that, looking at the PE ratio of the Nifty, well, as the veterans already know, uh, you know, that's obviously the peak PE ratio that we have had on the Nifty historically, and this is the bottom PE ratio that we have had historically, right? And where are we right now? Is there. So we are at 25, more or less, close to the, definitely expensive, no doubt about that, but not anywhere close to extreme expensiveness at this point. So there is definitely headroom left fundamentally for the market to go up from 25.5 to say just 28.5. So that's about uh, 3 points, about 12%, which roughly at the current EPS with no EPS change basically means, just for ease of calculation, 10,000 plus 12% is about 11,200 on the Nifty could fundamentally happen without breaking the extreme peaks of 2001 and 2008. Not that it can't go above that, it could, but fundamentally, given the 18 years history we are looking at, 11,200 would definitely in the current environment. So essentially, if the market hits 11,200, if the Nifty hits 11,200 in the next few months, 2-3 months, or I would say even by the end of the year, because I don't see any great EPS changes coming up, then we will definitely be on the ultra expensive side. We are already expensive, very expensive. It will become ultra expensive, and the implications of that, well, are pretty obvious. But we'll discuss that in great detail when we do the deep FA review. So fundamentally, things are not. There's a greater downside risk than an upside risk, but technically it looks like it's upside. So it's short-term bullish, long-term bearish. Short-term bullish in the sense of technically bullish, but fundamentally bearish. But that does not mean there's a sell sign right now. It's just that it's expensive. It's as and when the market really sort of decides to turn, that is when the real sell opportunity will come. But if you're a conservative long-term investor, then this would be a good time to start offloading your portfolio on a general basis, not a stock-specific basis. There will always be individual stocks which will do exceptionally well, even in the most expensive markets, and we are definitely not yet there. So PE-wise, yep, that's the case. Any really ultra-aggressive long-term bears could, who knows, start looking at shorting the market as it goes higher and higher. And I use my terms very specifically: ultra aggressive long term bears, as in over the next 6 months to, let's say, 1 year, right? Not necessarily next week or next month. All right, so that's the PE view. Looking at the dividend yield, as well, coming to a pretty low level. Clearly it is there at this point, and again, not very far from where it has been before in terms of 2008 being ultra expensive. And for those of us who know, we know that dividend yield is read upside down, just in case anybody is wondering. So lower it is, the more expensive it is; higher it is, the cheaper it is. So we are definitely on the expensive side now. And 1 second, PE. Okay. All right. Some setting issues which we will look into when we do the deep FA. And looking at the price to book value ratio, we are again definitely on the expensive side, no doubts about that. So that is when it was ultra expensive. This is when it was like ultra cheap. That was ultra expensive. Right, and right now we are there. So definitely not ultra expensive. So at least there is this ratio which has really not gone to its ridiculous high levels. But nevertheless, so if one wanted to make a case for is there any fundamental headroom for further upside, yes there is. This is not definitely anywhere close to a 2008 type situation where things were ridiculously expensive out of any sense of proportion or financial um, decision. It was just nonsense basically. So we are definitely not there, right? So there is scope for up moves, but we'll have to see how that pans out. uh, and we are at the end of or in the beginning of September. So this would be the second quarter of the current financial year, and mid-October will be the quarterly results streaming out. There could be some surprises there for sure. Right. All right. So PE expensive, but not ultra expensive. Dividend yield expensive, not ultra expensive. Price to book value ratio sort of expensive, right? But nothing ridiculous. So that's the overall PE view. Just looking at the EPS very quickly, you can very clearly make out how the EPS has been faltering for the entire 2015-2016 level. Has peaked a bit, but whether this is sustainable long term, etc., that's a different question. So there is EPS growth, and all said and done, from that perspective, growth is there. Except for the last 2 years, it has really not been there. So we've sort of crossed the 2015 high, but nothing beyond that. And with the recent reshuffling of the Union Cabinet, there might be a renewed focus on the economy. I don't know, but they will also be a great challenge in terms of, obviously there'll be now a lot of political attention being paid to the general elections of 2019. So the next 1.5 years, you might see a lot of populist stuff. And so I would say mixed views going forward, 50-50. Let's see how what any stimulus or packages or reforms, etc., that the government has going forward. Dividend has clearly come down, as you can see. So while EPS has gone up, dividend has come down. That's a bit of a surprise. We'll need to look deeper as to why it is so and in which sectors this has happened. Is it because the overall it has come down, or is it because of particular key sectors that are doing this? Right. Again, that will be part of the deep FA review. We don't have the time or the bandwidth to do it in the IMR. Book value. Wow. So this is phenomenal. Book value has gone up very considerably and very sharply, very clearly. And looks like for the last July, when the quarterly results came out, quite a decent and appreciable increase in book value from 2,600 to 2,800. So that's about 7-8% in a quarter, 6-7%. Not bad at all, right? So book value clearly looking very strong, very healthy, and the trend of book value going up remains as strong as it has ever been, right? So fundamentally, there is some hope, or rather not, shouldn't use the word hope. There is reason to say, statistical data evidence to say that further upsides are possible from a fundamental perspective. but at the same time, things are definitely on the expensive side, and I would at least say that 1.5 out of 3 red lights are on, and when it comes to 2.5 red lights being on, then one should be extremely cautious about one's long positions in the spot or derivatives market. Again, from a very general market wide Nifty perspective, no comments at all or views at this point on individual sectors or individual stocks. That we will definitely look into great depth and detail in the deep FA review. So just to summarize on the Nifty, upside headroom fundamentally still possible without the market becoming extremely expensive. It is expensive, but without market becoming extremely expensive, some upside of about 5-10% is possible, right? But in the longer term, over the next few 6 months to a year, I would say fundamentally there is a much higher downside risk than an upside risk, right? So that's the fundamental view. Coming back, therefore, to the NSE. So technical resistance at around 10,100. I would say fundamental resistance at around 11,000, 11,200. And if 9,700 breaks down, then definitely some short-term reversal is has definitely happened. Right. All right. So I would say a little tough for a trader, Nifty trader. It's in the sort of no man's land, neither here nor there. So really, no, deep comment on this. Individual sectors may, however, give us some really good clues as to what may or may not happen in particular stocks. We'll take a look at that in this IMR itself. So moving on, going to the Nifty next. So interesting. So Nifty next generally sort of mid cap stocks, the Nifty large cap stocks, and that has actually made a new life high on the closing basis yesterday, and then today it has clearly, sort of made a um, bearish engulfing pattern. On the indicator side, things are all pretty much okay. Uh, could be some bearish divergence. So if you look at the weekly chart, right, this is where we are, right? And as far as the indicators go, weekly indicators, there is not anything particularly great. But then in a strong up bull market, this is something that one can expect, right? So Nifty next, really nothing. But yes, strong moves, creating new life highs is something definitely happening in the mid cap space. Moving to a large index, CNX 500, more or less this copy of Nifty, but it's much closer to its very recent life high than the Nifty. So it looks like the broad market, composed of course, mostly a lot of mid cap and small cap stocks, is doing actually far better than the large cap stocks are doing. That's pretty clear from this analysis. Um, Now moving on to the individual sector indices, we will only be doing the sector analysis, technical analysis, sorry, of the sectors. We will not be doing the fundamental analysis of the sector, individual sectors in this IMR, but this will definitely be done in the deep FA. Each and every sector here, plus some others, thematic sectors and strategy sectors, data which we now have and is available. We will be doing very, very detailed and fine analysis of that from a fundamental perspective, and looking at what sectors and probably even individual stocks one could go long or short on from for a very I would say substantial up move or down move. Up move in the range of, who knows, 50, 100, 200% over 1 or 2 years, and a down move of who knows, even 30, 40, 50, 60% if things are ridiculously expensive for individual sectors. So that we'll do in the deep FA review. Now we look at the technical side of things, right? So Bank Nifty, more or less a copy of the Nifty itself, as you can see. So just about the same analysis that we discussed in the Nifty applies to the Bank Nifty. Consolidation, no clear direction. But if we add the CNX PSU Bank Index, then clearly the PSU banks are doing badly. You can see the big steep fall in August. September it continues. Today has not been a good day for PSU banks. So whatever strength you're seeing in the Bank Nifty is very much on account of private sector banks. And we had mentioned that in the previous IMR that the private sector banks themselves seem to, for after as far as I can remember, first time in almost a decade, seem to be having their own separation of some private sector banks doing exceptionally well and others really not in the doldrums. So we'll see whether that's true even of today, but definitely select private sector banks are the ones that are driving the Bank Nifty up. But the PSU bank pack as in general, and I'm sure some individual private sector banks are contributing to the Bank Nifty going. Uh, Having the downward pressure, and therefore the Bank Nifty really not doing anything. But it's interesting that the Nifty and the Bank Nifty have overall a very, very mirror-like pattern. Looking at the individual indices, starting with auto, no particular reason. Right now, this is definitely something interesting in the sense that are we looking at a potential head and shoulder top here? Left shoulder, big head, and maybe a right shoulder, may not be a right shoulder. It could be a consolidation. It may be a head and shoulder in progress, too early to say. What is definitely something to be sure about is that Nitin Gadkari gave a keynote address at an auto conference, and he very clearly told or made a very straight-faced and a very, very straight announcement to the who's and who of auto industry in India that look, go electric or get bulldozed. The government will force you, the industry will force you, the technology will force you, and not all the Indian companies are pretty happy, are rather happy with that view. Very clearly said, and you can watch all of this on TV, that he just wants the companies to move away from diesel and petrol. And so the era of internal combustion, at least for the private vehicle side, is probably limited, maybe who knows, 5-10 years tops. I don't think the government is going to look that long, at least from the way they're talking. And so you could maybe next 3 years buy your last internal combustion engine vehicles. After that, looks like it'll be, if not all electric, it'll be predominantly electric. Okay. All right, so BSE Auto Index may be reacting to that today with this bearish engulfing. You've got a lot of red candles. So overall auto index, really no view for the last 5 months. Could only say it's going sideways. The uptrend is definitely over. Whether this forms into a major top and then breaks down, maybe another couple of months or more, then only we'll know. Then looking at capital goods, they have done really well today, and big sharp up move after consolidating for a month. I think this is mostly on account of L&T. I don't know if it was on account of results, or it is perhaps also on account of the defense sector being perhaps now aggressively being looked at by the new defense minister, Nirmala Sitharaman. and who said they're going to be focusing on preparedness. And for those of us interested, you should Google up and read about strategic plan SP2, I think it's called, strategic plan 2 for the Indian defense industry, which has a massive element of inviting Indian corporates to participate in the manufacturing of arms and ammunition, and that's a massive, massive, massive market, which is perhaps really opening up in some meaningful manner in India only now. So we'll have to see how that goes. But yeah, capital goods looking bullish. Whether it will break this resistance or not, I don't know. Like I said, this is probably mostly L&T. We'll have a look at that later. FMCG. So this is predominantly weighted with ITC, and it's quite fair to say that not all the FMCG companies would be behaving this way. But all said and done, again, 4 months of sideways move, really nothing on the FMCG side. Right? The IT index, information technology, again, really going nowhere. As you can see, last 4 or 5 weeks, just sort of languishing, going sideways. This big drop was because of Infosys, only because of Infosys, really nothing else. But overall, right now, nothing major, and this uptrend is clearly broken, even, or maybe it is not, if I were to include it, but it's just sitting there. And what's the thing is, it's not been able to go back up to this return line here for the last 3-4 months, and on that account, usually not a very healthy sign. And we see a symmetrical triangle here on the weekly chart. Looks like it wants to break down, but nothing definitive yet. So IT 2015, 2016 sideways, 2017 now looking a little iffy, may go down to 8,730. We'll have to wait and watch. All right. Bse Metal, well, that's been doing exceptionally well since late June. A weekly chart, really fantastic up moves. Looking at it on a daily chart now, once it broke out of this level at around 11,500, it's gone to 14,000 in the last 2 months. That's really, really something. And so this is the thing, after almost 6 months of consolidation, move happens, and then it has just kept relentlessly going up. So metals are all definitely long, has come to a resistance zone now, and then whether it'll break out of it or not, right now multi-year resistance at around 14,000, that is something to be watched out for. And who knows, from 14,000 it could go to 18,000, and that itself another 4,000 point move. Right now, if you look at the overall market, doesn't look like it should happen. When I say that, I'm saying Nifty, but who knows, metals could be one place where one could really be pleasantly surprised. And just to add things up, it little bit of a what I suppose dichotomy. The overall economy is slowing down, but metals, core investment stuff, and capital goods are starting to, or metals have already moved up, capital goods also starting to move up. Is there some investment activity that's going on deeper, not obviously visible to retail? And is the economy getting into higher gear in the next few quarters? Who knows? Also, some news about how a lot of the metal companies are working at 80-90% capacity already, and that expansion is due. And remember that a lot of that capacity was lying idle for a long time after the 2008-9 crash. And of course, new capacity has also been built, but still, for quite a few years now, it was not operating anywhere close to 100%, and we are getting there. And that just means that been a massive consumption of metals. So looking good. Some correction can be expected with a sort of almost unilateral one-way move from 11.4 to 14,000, because especially if you look at it on a weekly chart, there's only 1 week when some consolidation at best happened. It's moved one way. So reaction or a correction down or a sideways move on metals is something that can't be ruled out. And after that move, then a breakout of those levels, or maybe it's breaking out now itself, is entirely on the cards. Right. All right. So that is metal. Then, so you should definitely be looking at the individual metal stocks for opportunities. The power index, right? So really going sideways, nothing to say. There is a symmetrical triangle, so till it breaks out, no comments. We'll see after it breaks out what we can, which way it goes. The reality index, so that started to look up. There's been so this is like that metal index also. It's come back to a very close to, metal index has, this one hasn't, but it's very close to a multi-year resistance level of about 4 or 5 years. And if it breaks this, then there is another 1500 point headroom, which is almost like almost double, if not double, 80%. And let it take 2 years to do that. 80%, almost 40% per year. 2 years spot return, fantastic, right? So reality technically looking to break out. So reality, metals, and capital goods are three areas which could really be driving the market up in the coming weeks and months. What is definitely a drag on the market is the IT part and the banking part, especially the PSU banks. So what is the bank? What is the uh, what, especially on the bank side, the NPAs, which are building up, and the government says they're going to do something about it, but God really knows what that plan is. The bad bank plan seems to be not finding a lot of favor. Merger of the smaller Indian banks, public sector banks, has happened, but NPAs are basically getting pushed on to the bigger, well-capitalized banks. So there is definitely a systemic issue there. Of course, this liquidation proceedings and going after defaulters sort of becoming a little more aggressive, more systematic, process-driven, etc. So that could help in the cleaning up, but I'm not aware of any proper visible action plan which is really going to address the issue. So if a few banks do badly or the results keep coming out badly, it could be, we could see a very substantial, okay, not very substantial, but a substantial enough drawdown of the banking stocks, and that will be a drag on the market. So some sectors really bullish, and others sideways, like auto. And where is pharma? We missed pharma, right? Pharma is another really sector which is dragging the market down, and as you can see, it's really been pushed down. So uh, uh, no hope on pharma, obviously. Really not able to see what when recovery could happen. Though if you look at it from a very long term perspective, it has come to a 2014 support zone. So 3 years, and from here we could see some recovery, but again, really too early to say. And what's on the weekly chart here is, well, surprise, I'm just wondering. Yep, definitely a bullish divergence on the weekly RSI. All right. So is the worst for pharma over? Too early to say that. maybe the deep FA review will tell us some things, right? The fundamentally whether pharma is cheap or not, because that has fallen from its highs of almost 14,000 to 8,000. So, you know, about a 40% fall, and that could have made the pharma fundamentally attractive, but that we'll look at in detail in the deep FA review. So anyhow, this is really interesting. I think from that sort, from this, what we've looked at the sector indices, some breaking out from multi-year resistances or at the verge of that, others going sideways and really not giving us any clue. So again, at the sake of repetition, the ones that are potentially breaking out from multi-year resistances are realty, and metals, and which one was that? Capital goods, right? So these three potential breakout from multi-year levels. When I say potential breakout, in the next few weeks, maybe 1 or 2 months. On the other hand, the overall Nifty, forget the Nifty, the banking stocks, uh, uh, especially the PSU banks and the IT stocks, which are both of them together have a substantial weightage on the Nifty, are the big draggers. Negative biases on that. But apart from that, things like Fmcg and you know, this is all weekly stuff. Fmcg and autos, right? These two are all sideways, so mixed bag. So this is how it is set up technically, and I'm sure the deep FA review that we do in the next couple of weeks will give us far more insight into how we can address and resolve this and get a much better sense of what the direction of the market is. So we'll probably be finding a mix of longs and shorts in the individual stocks, I'm sure. Some will be really good longs, some will be really good shorts, and there'll definitely be a bunch of things that you just want to stay away from in the couple of next few weeks, or even perhaps even months, right? So that's all part of IMR 2. So to wrap up, IMR 1 part 1, no global cues, pretty balanced, but I would say significant global risks. One is on account of uh, North Korea. The other one is on account of things like the German elections politically, and then there is all the natural disasters and calamities happening in the U.S., which could undermine the U.S. economy now and affect it quite substantially. You're talking about 180 billion, I think, only for Houston, and now if Florida gets really damaged, then who knows? We're talking about either easily 200 to 250 billion dollars. But on the other hand, think about it, all that reconstruction, all that rebuilding, which will go on for months and years, could be a massive economic stimulus and activity. In the short term, really bad, but in the long term, could be a massive opportunity. And well, coming to think of it, if anybody is looking at individual US stocks, they might be pummeled in the short term because of the hurricanes and the fires. But on the other hand, there'll be a whole different set of stocks which are going to benefit massively from the reconstruction effort, right? So anybody in the US markets, anybody looking there, wonderful opportunities which I think are just staring at us in our face. If you want to see them, they're there, right? So that. All right. So with that, let's close IMR 1. We'll have the next webinar with IMR 2, right? And we'll look at perhaps not just the Nifty stocks, but maybe some from the Nifty Next 50 also, right? Thank you, and see you on the other side. Bye.